So we are going to continue from where we stopped last time. We started with short-term decision last week, and then we said that short-term decision represent the application of marginal costing technique and then the principle of relevant costing to analyze a particular course of action in making managerial decision. Not only that, we also explained what marginal costing technique is all about. We said that marginal costing technique is a concept that is used to compare the cash inflow versus the cash outflow of a particular course of action, whether it will generate additional profits or loss or even contribution for an organization. We said marginal costing technique is a concept that relies heavily on the behavioral classification of cost, in that management may want to know. You guys have started again. You have started again. Simple instruction. Please, always mute yourself. So, we also said that marginal costing technique relies heavily on behavioral classification of costs, in that a cost item must be capable of being classified as either variable or fixed cost. Not only that, we also said that management may want to know, that is, marginal costing concept is also cost-benefit analysis. It's also known as cost-benefit analysis, because management may want to know, or management may desire to know, that whether a benefits arising from a particular course of action will outweigh the associated cost. Okay. Not only that, we talk about the need for management to make quality decision, because the quality of the decision making will have far-reaching effects on the company's performance in the marketplace, because a bad decision can result to financial losses. It can impair the image of a company. Not only that, it can limit the capacity or the ability of a company to take advantage of market conditions. And that's why it is necessary for the company, or for the decision maker, for the management accountants and whoever that are responsible for making that recommendation to the management, to always seek guidance from the top level management within the organization, to seek guidance from the requisite decision maker, in order to avoid any wrong decision being made. All right. And we said anything you want to do under short-term decision must be critically examined under two perspectives: the economic perspective and the qualitative factors. We said all the relevant calculations that are involved in the decision that you want to make is the economic angle, okay? Because economic angle represents the process of determining the economic and financial viability of the decision that is to be made, whether it will generate contribution, profit or loss, savings or deficits for the organization. So these are the economic angle of the decision that is to be made. Any other factors that cannot be expressed in monetary terms is what is known as a qualitative factor, or non-monetary or non-quantitative or non-quantifiable factors. Okay, so these are the things that we discussed last time. I think we also, of course, we started with, we now said that marginal costing technique, we talk about the uses or applications of marginal costing technique. I listed about 8 or 9 of them. We said that marginal costing technique can be used in the deleting of a segment, okay? So we also said that marginal costing technique can be applied in make or buy decision, acceptance or rejection of a special order, shutdown of capacity, adding of a new segment, linear programming, optimal product mix, cost volume profit analysis, pricing decisions, and all of that. I listed all of them for you in our last class. Then after that, we now begin to talk about each of them one by one. We started with discontinuance of a segment, okay? We said that under this discontinuance of a segment, the only reason that we make management to be contemplating on deleting of a particular segment or of dropping a particular segment is because that segment is operating at a loss. Therefore, under deleting of a segment, the most important thing you need to do is to compare the cash inflow from that affected segment versus the relevant cost of making the segment. So whether it will result in the positive or negative contribution using contribution margin statements or income statements. So the most important thing is whenever you are given a question and examiner is asking you to advise whether the company should drop or the company should discontinue that particular segment, all you need to do is to just compare the revenue versus the relevant cost of the affected segment. Other segments that are profitable, you have nothing to do with them. So your focus should be on the segment that is operating at a loss, okay? So just compare the sales value versus the relevant cost of making the segment, okay? Okay, so yes, and then last week we also talked under the discontinuation of a segment. We also talk about the qualitative factors. So just to as a recap on what we did last time. So I gave you the format, okay, the same format I gave to you last time. We talk about the decision rule that under the deleting of a segment, once you have calculated the you have prepared the economic analysis using contribution margin approach. Once you have a positive contribution, okay, once you have a positive contribution, your advice should be that the company should not delete the segment because the segment is actually contributing positively towards the recovery of the company general fixed overhead and then net profit, okay? In as much as the segment is contributing positively, do not delete, do not discontinue the segment. But if the segment generated a negative contribution to the organization, then your advice should be that the company should delete the segment, which will then increase the overall net profit of the organization. What if you have zero contribution? That is where your total revenue will equate your total relevant cost. So once you have zero contribution, then the company can either delete or not delete, depending on other qualitative factors. So all of these are what we discussed last time. And then these are some of the qualitative factors. I think I gave you about 7 or 8 qualitative factors. So I don't want to go there again. So yes, and then we solve this illustration number 1. Okay, so let's have another illustration now so that we can, if possible, I'm not sure, we cannot complete this topic today. So, but let's see where we are going to finish tonight. Okay, then. So, yes, let's have another illustration. And then before we go into solving question, let me hear from you. Is there anyone that is just joining for the first time? If you are not in the class last time, let me hear from you. If you are not in the class last week. Okay, these are regular people. I'm checking your name now. So these are regular people. I'm not sure there's any new person here. All right, then let's move on. Yes, I need somebody to read for us. Ife Sinachi.
Ife Sinachi Limited.
Thank you, Tife.
Making a single product. Has a factory in Lagos and distributes the product through 3 depots in Lagos, Benin, and Kaduna. It is estimated that during the coming year, 100,000 units will be manufactured and sold at a price of 20 naira per unit. The sales being spread as follows: Lagos 7,000 units, Benin 20,000 units, Kaduna 10,000 units. Standard costs of production are direct material, direct wages, factory variable overhead, factory fixed overhead. The cost of selling and distribution incurred by the depot are estimated as follows: Lagos 80,000 per annum, Benin 50,000 per annum, Kaduna 30,000 naira per annum. Variable selling expenses: Lagos 5% of sales value, Benin 8% of sales value, Kaduna 10% of sales value. From the budget for the business prepared from these figures, management is considering desirability of closing the depots and selling organizations in Benin and Kaduna. If this is done, it is expected that all sales in these areas will be lost, but that sales in Lagos will remain unaffected. Required: A. Prepare a budget for the business from the figures provided, indicating why management is thinking of closing the depots in Benin and Kaduna. B. Redraft the statements prepared above using contribution margin approach. C. Prepare a statement using the historical approach to show the net profit of the organization after closing down the two depots. Advise the management based on the income statement prepared above.
Thank you very much, Tife. So that is the question. In the requirement number A, you have to prepare a budget for the business for the figures provided, indicating why management is thinking of closing the depots in Benin and Kaduna. Based on my previous explanation to you, you can see in these requirements, we are told that management is thinking of closing down the depots in Benin and Kaduna. So one thing should cross your mind, that what could make the only thing that can make the company that can make Ife Sinachi Limited to be contemplating on closing down Benin and the Kaduna depot is because maybe Benin and Kaduna depot are operating at a loss to the organization. Remember, my explanation is that the only thing that will make management to be thinking of dropping or closing down or discontinue or deleting a particular segment is because that segment is operating at a loss. So as you can see from this question, examiner did not give to you income statement. So the income statement is supposed to show to us the operating performance of each of the depots. Okay, we want to see the net profit or loss for Lagos, Benin, and Kaduna, but examiner did not give us the income statement. And that's why the examiner is asking you the A requirement to prepare a budget from the figures provided for you. Then you should indicate why management is thinking of closing down Benin and Kaduna depot. So if that is the case, now, since we are not given the income statement, examiner is asking to prepare budget statement. Budget statement is the same thing as income statement. Okay, examiner can call it budget statement, income statement, operating statement, historical state, whatever the statement you ask to prepare. Once it is, if it is a statement, just go ahead and prepare your income statement, which is the same thing, to show the profit or loss. So without wasting more time, let me stop sharing this and go to the working note so that quickly within the next few minutes, we can complete this question and move to the next one. Let me know if you can see my screen.
Yes, sir.
All right, then. Thank you. So the name of this company is Ife Sinachi Limited. Number A, examiner wants us to prepare budget statement. Don't say because budget statements, income statements, operating statements, historical statement are the same, that you now use a different name. Examiner says you should use budget statement. That's what you are going to write. So I will say budget statements. Okay. I can come here and say there is no need for you to say budget statement for Lagos, Benin is a waste of time. So the only thing I can do here is to say, I can just restrict my numbers to thousands, okay? Then I will come here, Lagos. Now, there are 3 depots. Ife Sinachi operate from 3 depots in Nigeria: Lagos, Benin, and Kaduna. So you are going to create 3 columns for the 3 depots, then additional 1 column for the entire organization, because you want to see the operating performance of the whole organization. Therefore, I will create a column for Lagos, Benin, Kaduna, then total. The total is for the entire organization. Okay? Therefore, remember, we are preparing income statement. The first item will be the sales value. So I will then say sales. I will go back to the question, how do I calculate my sales? Remember, sales value is determined as units sold multiplied by selling price per unit. According to the question, examiner has told us that in the first paragraph, you are told that it is estimated that during the coming year, 100,000 units will be manufactured and sold at a price of 20 naira per unit. The sales being spread as follows: Lagos 70, Benin 20, then Kaduna 10,000 units. So let's go and indicate that. Before the sales, we need to consider the activity level, or just simply put, units. So Lagos is 70,000. Okay, 20,000 for Benin, then 10,000 for Kaduna, 100,000 for the entire organization. Okay. So I can then say sales. Selling price per unit is 20 naira. Therefore, 20 multiplied by 70,000. That will give me 1,400. Remember, our figures are in thousands. 20 multiplied by 20 will give us 400. 20 multiplied by 10 will give us 200. When you add everything together, that's 2,000. So I've accounted for the sales. The next item will be relevant costs. I don't know why you guys are very stubborn. Always mute yourself. I don't know why. You are distracting the class. Simple instruction. So we go back to the question. Remember, you want to determine relevant cost. The first thing you are going to do is to check from the question, do you have direct material? Do you have direct labor? Do you have direct expenses? Is there any variable overhead? All of this, you are the one that will be asking the question. So in this question, I can see direct material of 4 naira 80 kobo. So I will say direct material. Direct material at 4.8. Again, I also have direct wages. Direct wages is 3 naira. Uche, if you distract the class again, I will remove you. I don't like it. It's disruptive. Please. Next, I will go back to the question. As you can see, we don't have direct material. Sorry, we don't have direct expenses. So, but we have factory variable overhead. So there's factory variable overhead. So let's go and account for that. Factory variable overhead. How much is that? Which is 140% of direct wages. So I would then say 140 at 140% of direct wages. Let me see if that space will, no, I've extended beyond the normal space. Let me write this. So factory variable overhead at 140% of direct wages. What else? Let's accumulate all the relevant costs. Okay. Factory fixed overhead is not a relevant cost. It's not relevant. But we also have selling expenses. We are told that the cost of selling and distribution incurred by the depot are estimated as follows. So we have variable selling expenses. We also have fixed selling expenses. So all of them are relevant. Let's account for them. We have variable selling expenses. We are going to do our working for that. We also have fixed selling expenses. So first thing first, let's account for all of this. So bring out your calculator. I want to determine total material cost. Let me rewrite this material.
6,720.
6,000.
720.
That's not possible.
1,000.
70 multiplied by 4.8.
336.
336. Okay.
Oh, I did 1,400.
Yeah, on your own. 336.
96.
96. Okay. Next. 48.
48.
Right?
Yes,
Okay,
sir.
then 480. Am I correct? Please check. That should be 480.
480.
Okay, then. So that's the total material cost. Then for direct wages, 3 multiplied by 70 will give us 210.
210.
3 multiplied by 20 give us 60.
60.
3 multiplied by 10 will give us 30. Okay. Then 3 multiplied by 100 will give us 300. So that's total direct wages. So examiner is now telling us that factory variable overhead. Factory variable overhead is 140% of direct wages. Our direct wages is 210 for Lagos. Therefore, 1.4 of 210, what do you get? 210 multiplied by 1.4.
294. 294.
That's 294. 1.4 multiplied by 60.
84.
84. 1.4 multiplied by 30.
42.
42. Then 1.4 multiplied by 300.
420.
420. Thank you. So we are done with that. Then variable selling expenses. Examiner told us that the variable selling expenses is 5% for Lagos, 8% for Benin, and 10% for Kaduna. So the selling expenses is on sales. So percentage on sales. So let's go and account for that. Let's say this is the first table, second table. Let's say our working should be somewhere here. So I would then say working. So working number 1, variable selling expenses. Okay. So for Lagos, we are told that Lagos is 5%. The total sales for Lagos is 1,400. So what's 5% of 1,400? For Benin, 8%. 8% of
That's
400.
70.
70. Okay. Then for Kaduna, 10% of 200.
32 for Benin. 32.
Here is 32. Then here is 20.
20.
When you add it up, that's 122. So that's total variable selling expenses. So let's go and account for that. Variable selling expenses here is working number 1. Okay, 70, 32, then 20. Total is 122. Next item, fixed selling expenses. Let's go back to the question. Fixed selling expenses is 80,000 naira per annum for Lagos, 50,000 naira and 30,000 naira for Benin and Kaduna, respectively. So here is 80,000, 50,000, then 30,000, making 160,000. So what other relevant costs do we have in the question? Okay. Now, somebody will ask me, why is fixed selling expenses a relevant cost? Of course, fixed selling expenses is a relevant cost because if you don't incur the fixed selling expenses, you won't be able to generate the sales. That's the implication. So any expenses you incur to make the sales are relevant. Okay? Any expenses you incur to make the sales are relevant. All right? So that's that. So any other expenses in the question? No one again. That's all. So if that is the case, then let's determine our contribution. Let's determine our contribution. Add up your sales value minus total relevant cost. What do you get? Yes.
410 for Lagos.
For Lagos, 410. Thank you, Kunle. Yes.
78 for Benin.
Benin, 78.
For the
For
total,
Kaduna. For Kaduna, 30.
Kaduna is 30.
total is 518.
518. Thank you, everyone. So that's total contribution margin for all the depots and also for the organization as a whole. From this contribution margin, you need to deduct period cost, fixed overhead. Remember, when we had marginal costing technique, we said that marginal costing technique is an accounting system whereby the period cost or the fixed costs are written off fully from the aggregate contribution. So let us deduct the fixed overhead. Did the examiner call it fixed overhead or factory fixed overhead? Yes, factory. So let me write this. Factory fixed overhead is 400,000 naira. This 400,000 naira is supposed to be apportioned among the depots. The entire 400,000 naira will be apportioned among the depots. We go back to the question, did the examiner tell us how we are going to split the fixed overhead? Examiner did not tell you how the fixed overhead will be split. Therefore, whenever you are not told on the basis of apportionment of fixed overhead, you can either use sales value or you use number of units or whatever the basis examiner has given to you. Remember, when you talk about overhead apportionment, there are different bases that organization can use. You can use on the basis, you can apportion on the basis of floor space. You can apportion on the basis of number of employees in each of the departments, depending. Then you can also apportion on the basis of course, I mentioned square meter. Okay. However, in this question, the examiner did not tell us all of that. In that case, you are going to look for something that unify, something that is uniform, or something that unify all the depots, something that is common to all the depots. So in this question on the first paragraph, examiner has already told you that it is estimated that during the coming year, 100,000 units will be manufactured and sold at a price of 20 naira per unit. And you are now told further that the sales being spread as follows. So the 100,000 naira is what that is common to all the depots. So 70, 20, and 10,000 units for Lagos, Benin, and Kaduna respectively. So on the basis, you are going to use the number of units in this case to apportion or to distribute the fixed factory fixed overhead. So let's quickly go and do our working for that. Working number 2 now. When you talk about apportionment, it simply means it's distribution. You are distributing costs. You are sharing costs among several units within an organization. So factory overhead, factory fixed overhead, apportionment. So let us distribute the 400,000. So I will save factory fixed overhead of 400,000. Our figures are in thousands so that you don't make a mistake. You have to be careful. If you have already restricted your number to thousands, you have to use that consistently so that you don't use absolute numbers somewhere, then you are using rounding somewhere in another place. So you want to allocate the 400,000. I would then say distribution. So for Lagos has 70,000 units. So that will be 70,000 divided by 100,000 units, multiplied by the 400,000 that you want to allocate.
That's 280.
280, thank you. Then for Benin, 20,000 units is allocated to Benin out of 100. Then multiply by the 400,000 that you want to share. So 20% of 400 will give us 80. Okay. Then for Kaduna, 10,000. Who is coming? Who is Antibuki there? Okay. Multiply by 400. Okay, 440. So at the end of the day, when you add it up, you must give it the total 400,000. So this is the factory, total factory fixed overhead. So we have apportioned this. So let's go and post. So you only do this when you want to determine profits. Had it been his only contribution that we want to determine, if had it been we are preparing contribution margin statement, we would have stopped at contribution. But because we want to determine income statement, you want to determine profit or loss. That is why you have to deduct fixed overhead from the contribution to have net profit or loss. So here is 280. Let me rewrite it. 80. Then a 40. Total is 400. So we find the difference.
That's 130 for the first one. Lagos 130.
Lagos is 130 minus 2 minus 10, then 118. So this represents the net profits. Okay, so examiner is asking you, in the A requirement, examiner is asking you to prepare a budget for the business from the figures provided, indicating why management is thinking of closing the depot in Benin and Kaduna. So you can see the reason why now. You can see that Benin and Kaduna are operating at a loss. Loss of 2,000 naira for Benin, loss of 10,000 naira for Kaduna, and that is why the management is contemplating of closing down both depots. So that's number A. We move to number B. In number B, examiner is asking you to redraft the statement prepared above using contribution margin approach. So in this case, examiner is asking you to use contribution margin approach, which means that for each of the depots, you are going to stop at the contribution margin. When you are asked to use contribution margin approach, so for that particular affected segment, so, but again, examiner is saying you should redraft the statement, the one you have prepared above. So you are going to do it across board. Therefore, you stop at contribution margin for each of the depots. But for the organization as a whole, the 400,000 of the fixed overhead that have been incurred, it is the entire organization that will bear it, not the depot, because the examiner says you should use contribution margin approach. Therefore, I then go ahead for the second table. The second table cannot occupy under this. Let's go to a new page. Okay. Number B. So we have to use contribution margin approach. I would then say contribution margin approach or statements. Okay. Our figures still remain thousands. Lagos, Benin, Kaduna, then total for the entire organization. So, sales value. Had it been I'm using the whiteboard physically in class, I would have skipped this one. I have to rewrite it again. So what it simply means is that, okay, maybe I can even use this one too. Let me find out from you first. Are you copying this or I should clean it? So that
We
you
are
see if I...
copying
Yes, sir.
Oh,
So I thought
okay.
you're going to send it to the
You
this
can just
thing.
send it to the group, then we can use it
You're
together.
going to send it to the WhatsApp and this
Please,
thing for
one
us to
after
be
the
able
other.
to get it.
There's a commotion. There's a commotion. How about, please mute. What I'm saying is that because what the examiner is asking us to do is the same thing I've done. I'm supposed to stop at contribution. That's what the examiner wants you to do. But again, since you are still copying, no worry. I will just rewrite it.
We are done. I'm done, sir.
Okay.
Thank you, sir.
So if you are done, then
What about others?
okay, don't worry. Just continue doing what you are doing. No worry. The sales value for Lagos is 1.4. Lagos is 1.4, 400, 200, then 2,000. Relevant costs. Of each depot. We have direct material, and then our direct material is 336.9648. 336.9648, which is 480 total. We have direct wages, and then our direct wages is 210 60 30. 210 60 30, which is 300. Then after direct wages, we have factory variable overheads to be 294, 8442. 294, 8442, which is I think 420. Yes, 420. Then after factory variable overhead, we have variable selling expenses. Variable selling expenses is 70, 32, 20. 70, 32, then 20. 1, 2, 2. We have fixed selling expenses, which is 80, 50, then 30. Total is 160. I think that's all. Let me confirm. Yes, that's it. So they will now determine our contribution. Congress, what's your question? Talk to me. Congress, go ahead. Congress, you raise hand.
Might be network, sir.
Pardon?
Can you hear me, sir?
I can hear you.
All right. This fixed selling expenses, I don't
Yes.
see understand why is as in is recorded as relevant cost.
I explained it. I said that any expenses you incur to make sales are relevant because if you don't incur the fixed selling expenses, you won't be able to generate the sales. Do you get? So
Okay.
whether it is variable or fixed, any expenses you incur on to generate sales, they are relevant.
All right, sir. Thank
Yeah.
you.
You're welcome. So that is 410. After 410, we have a 7830. Here is 7830, then 518, which represents contribution margin. This is contribution margin. So like I said, because examiner wants us to use contribution margin approach, so this is where you are going to stop for each of the depot. But for the organization as a whole, the company has incurred fixed overhead of 400,000 naira. So factory fixed overhead. So it is the organization as a whole that will bear the entire 400,000. So which means that the net profit still remain the same. So net profit. This is what examiner wants you to do in the B requirements. So that's that. Then number C, you have to prepare a statement using historical approach to show the net profit of the organization after closing down the two depots. Now, examiner is saying that because Benin and Kaduna depot are operating at a loss, therefore, we should close down the Benin and Kaduna depots. So if the company closed down Benin and Kaduna depot, only Lagos will subsist, only Lagos will continue. So the implication of this is that the entire factory fixed overhead of 400,000 naira will be borne by Lagos. That's the implication. Because remember our explanation, we said that if it is positive contribution, the segment should not be deleted because it's contributing positively towards the recovery of the company general fixed overhead. So now that Ife Sinachi Limited is no more producing, it's no more operating at Benin and Kaduna depot, so only Lagos will continue. So if only Lagos will continue, then Lagos should bear the entire 400,000 naira of factory fixed overhead. So let's go to C quickly. Number C, which is historical statement. Examiners say we should use historical statements. So historical statement is the same thing as income statement. Just put it there, the way examiners mentioned the historical statement. Okay. Now, you can say historical statement after closing down of Benin and Kaduna Depot, or you say it's historical statement for Lagos Depot, however you want to put it. You are still speaking the same grammar. Historical statement for or after closing down of Benin and Kaduna. We want to see what will be the impact on the company's overall net profits. If you close down Benin and Kaduna, what will be the impact on the company's overall net profits? So, in this case, since it is Lagos, my figures are in thousands. So, only Lagos will subsist. So, I would then say sales value for Lagos, which is 1,400. Then, relevant cost for Lagos. Relevant cost for Lagos. Direct material. Direct material for Lagos is how much is direct material for Lagos? 336.
336.
336. Then direct wages.
210.
How much is direct wages?
210.
210. Okay. Let me write that. Then we have factory variable overhead, which is
294.
294,000. We also have variable selling expenses. Let me write it out in full because of the space. Variable selling expenses. How much is that? Take 96 or pardon?
70.
70, okay. Then we have a factory, fixed selling expenses,
80.
which is 80. Okay, I think that's all. Now, the difference is 410. This represents the contribution, total contribution margin for Lagos. From the contribution margin for Lagos, you less the factory fixed overhead of 400,000, because since it is only Lagos that is now operating, so the Lagos will bear the entire factory overhead, which is the net profit is now 10,000. So that's that. This is what examiner wants you to do. That's what examiner wants you to do. Then yes, that's number C. You can see from A to C, you are not asked to advise. But finally, examiner is now asking you to advise the management based on the income statement prepared above. Look at in number A, examiner says you should prepare a budget statement. Number B, you have to redraft the statement using contribution margin approach. Number C, you have to prepare a statement using historical approach. Now in the requirement, examiner is now calling it income statement. You see? So whatever. So examiner is saying you should advise. So what should be our advice? Should we close down Benin and Kaduna Depot? I'm asking you.
No.
Okay, why shouldn't we close down Benin and Kaduna? Because Benin and Kaduna is operating at a loss. So why can't Ife Sinashi close down the Benin and Kaduna?
even that they are still operating at that loss, right? The bulk of the fixed expenses will still be covered up with the little that we can get from them, rather than closing it down. If you look at the profit, if it is closed down,
closure.
10, but if it is not closed down, the overall profit will be 118. So I think we can still manage them.
No problem. Yes, you are correct. We shouldn't close down. So let's advise. Let's advise. There's no space up there again, so let me just go down here. So we need to advise. I would then say if it's Sinachi Limited should not remember our decision rule under deleting of a segment. Once the segment is operating, once the segment generates positive contribution, your advice should be that they should not delete because it is contributing positively towards the recovery of the company general fixed overhead. The fixed overhead of 400,000 naira, they are contributing to recover part of it. So you shouldn't delete it. So I would then say if it's Financial Limited should not close down Bini and Kaduna Depot. Okay, and Kaduna Depot. Because it is not sufficient for you to just say if it's Financial Limited should not close down Bini and Kaduna Depot and you stop. No, that's not sufficient. You cannot earn your full mark in that regard. So you need to say the reason why. Because they are contributing positively towards the recovery of the company's general fixed overhead of 400,000 naira. Okay, so we need to go further. Currently, the overall net profits of if it's the overall net profit of Ife Sinachi is 118,000 naira. If Bini and Kaduna Depot, let me write that. That's not depot. Are shut down or are closed down. If Bini and Kaduna depots are closed down, the net profits will drop to 10,000 naira. This means that the reduction in profits of 118,000 minus 10,000, that's 108. This means that the reduction of profit of 108,000, that is 118,000 minus 10,000 naira is the positive contribution, or represent the positive contribution represents the positive contribution of Benin and Kaduna depots to the entire organization. To the entire organization. That is, open a bracket, 78,000. When you add up 78,000 with the 30,000 contribution of both, that represents the loss or the reduction in profit for the company. So represents the positive contribution of Benin and Kaduna depots to the entire organization. So that's it. So we've already made our point that the company should not close down Benin and Kaduna depots. So that's that. That's the question. That's the question. So let me know. Let me know if you have any concern on what we have done so far, so that we can move to the next one. We are moving to make or buy decision. Okay? So we are moving to make or buy decision. Let me know. Do you have any question under this Ife Sinachi before we proceed to the next one? Okay, so let's move on. Let me stop sharing this so that we can move to the next one. Okay. Stop sharing. Oh, sure. Okay.
Hello, sir.
Yes, talk to me.
So, from the three calculations you have just made now,
Yep.
it means that in any question we are asked to make a decision or to advise, the bulk of our decision will depend on that
Contribution margin.
contribution margin.
Yeah.
Thank you.
You're welcome. Okay. So let's not forget, you have an assignment for me, please. You are going to attempt illustration number 3, and then you must submit not later than Saturday. Today is Monday. Yes. So you have to submit not later than Saturday. So Please go and attempt illustration number 3. Cash and Pick Limited. Go and attempt it. I want to see how you are going to solve the question. So let's move to make or buy decision. Now, let me inform you. Make or buy decision is a very important aspect of short-term decisions because it also cut across some other topics under performance management. So you must take your time to understand the concepts so that even wherever you see it, once you understand the concepts, you can go no wrong, you can do no wrong. So you'll be fine at the end of the day. That's the implication. So let's talk about make or buy decision. Let's talk about make or buy decision. Please give me 1 minute. So let's talk about make or buy decision. One key thing you need to understand is that when it comes to make or buy decision, the company may have capacity to produce that component internally. The company can also have the resources to outsource the components. So generally, the bottom line, the main purpose of make or buy is to achieve savings for the organization and to ensure that a reliable supplier is available to satisfy the system, to satisfy the requirements. Okay? Those are the two things that will make organization to be contemplating on whether to make or to buy a component. I said one is to achieve savings for the organization, and two, to ensure that a reliable supplier is available. Okay, a reliable supplier is available to satisfy the existing requirements. Okay, so that is the primary purpose of make or buy. Now, let us discuss the concept. Yes, often within an organization, management may be thinking on whether a particular raw material, sub-assembly, or components required for the manufacturing of the company's final products should be produced internally or contracted to an outside supplier. The decision to contract to an outside supplier or to outsource can be said to be critical and at the same time strategic to the organization, especially if the company is operating in an environment where competition is highly stiff, okay? Where competition is highly stiff. For example, when you look at the banking industry in Nigeria, or you look at communication industry in Nigeria, there's hardly, say for example, if MTN Nigeria makes a particular move, within a twinkling of an eye, within few days, other competitor will react in similar way. So in such an environment where competition is highly stiff, then company needs to be very, we need to be very careful and strategic in the way they dish out information, because in most cases, information is a proprietary is an asset for an organization. So company will generally hold on jealously to any valuable information that can enhance the value of the business. And when it comes to issue of you outsourcing a segment of the organization or of a product of any activity to a third party, you need to be careful because of the need to protect the degree of secrecy or the proprietary technology that underline the company's product. It's very important. You don't just issue you don't just say because it is less costly for you to do, so let us outsource it. Before you outsource, you must be sure that if there's any proprietary information, you must be sure that that information will be protected and will not be given out to your competitor, because once your competitor gets hold of that information, the company is out of the business. So every product in the market has its own uniqueness. There is something that makes each of the products to be unique. You can say the products, all the products in the market may look the same, but they may taste, or there's something that will make each of them to be unique. For example, when you go to bakery industry, where people that are baking bread, there are different kinds of bread in the market. When you look at those bread, they look alike, but the tastes are different. Okay, the tastes are different. In similar vein, when you look at the lubricant industry, the engine head that we put for our generators, there are Mobil, there are Ohando, and several lubricants in the market. Why is Mobil lubricant more expensive than the other? It's because of the quality. All right, it's because of the quality. So what makes Mobil to be unique relative to other ones is the degree of secrecy. So if your competitor gets to know about the degree of secrecy underlying your products, the company may be out of the business, because what your competitor will just do is to blend it. They will improve on that your degree of secrecy and then make it better. Before you know it, you are out of the business. Then it is your competitors that will now take the market share. And that's why we are saying that before you outsource any activity to a third party, you must be ensured that the third party is going to protect the degree of secrecy underlying your product or that particular activity. So these are the introduction to make or buy decision. However, under make or buy decision, the most important thing you need to do is to compare supplier's quotation versus relevant cost of making, whether it will result in a saving or deficit to the organization. Remember, I told you earlier on, the primary purpose of make or buy are just two. One, to achieve savings for the organization. Then two, to ensure that a reliable supplier is available to satisfy the existing capacity level or the requirement. So these are the main reasons for make or buy. So when you now want to determine the economic analysis, you want to carry out the economic analysis under make or buy, the most important thing you need to do is to compare the supplier's quotation versus relevant cost of making the component, okay, versus relevant cost of making the component internally, whether it will result into a saving or deficit. So that is under the economic angle. Then, of course, before we go to the qualitative factors, so the format still remains the same. The format is closely related to what we have done under the deleting of a segment. The only difference is that you are going to pick, you go to the question, go and pick supplier's quotation. Supplier's quotation will always be given to you. So if your examiner does not call it supplier's quotation, they can call it buying price. That is the amount you are going to buy it in the market. That's the buying price. So that's the supplier's quotation. Then you now compare it with relevant cost of making the component. All those, your direct material, the direct labor, the direct expenses, the variable overhead, if there's any opportunity cost. So you may also have direct, attributable, specific, relevant, and then incremental fixed cost. Whatever the fixed cost that you have that is relevant to the production of the component, then you need to incur it. You need to include it. So you add up all the relevant costs together. So the difference between the supplier's quotation and then total relevant costs will give you either saving or deficit. So we now move to the decision rule. There are, again, two major decision rule. One is that if supplier's quotation, if supplier's quotation is greater than the relevant cost of making the component, of course, your decision should be that the company should make the component. The company should make the component because it will be cheaper. But if supplier's quotation is less than the relevant cost of making, then it's better for the company to outsource, to outsource or to contract the components, to outsource the production of the component to an outside supplier, That is, if supplier's quotation is lower than the relevant cost of making it, Then, what if supplier's quotation is the same thing as relevant cost of making the component? So in that situation, you should consider qualitative factor. Therefore, what are the qualitative factors under make or buy decision? What are the qualitative factors under make or buy decision? Now, as far as make or buy decision is concerned, there are two angles to your qualitative factors. You need to consider all those qualitative factors in a situation whereby the company wants to make the component internally. Then you also need to consider the factors where the company may decide to outsource the component to an outside supplier. So all of this is what you should consider when you are stating your qualitative factors. Now, if the company wants to make the component internally, what are those factors you must take into consideration? Say, for example, you want to produce component A. The first thing that should come to your mind is that, do you have the technical know-how to produce the component internally? Because if you don't have the expertise, what's the essence of why do you want to produce something you don't even know how to do, and you want to do it? It will be very difficult. Therefore, for the number one factor the company should consider is whether there is internal, or whether there's a technical know-how to produce the components internally. Then number two, the company will need to ask to provide answer to the question that, are we permitted by law to produce the component? Are we permitted by law to produce the components internally in addition to the company's final products? Because not all products are permitted by law. There are some states in Nigeria today that you cannot do some certain businesses. So provided the law of the land does not permit it, then there's nothing you can do about it. So you need to find out first. And that's why before you set up a business, before you begin, before you commit your hard-earned financial resources into any business, you make your findings in order to minimize your exposure to risk. You can imagine if you have spent so much money, and then at the end of the day, the government of the land is now telling you that, no, you can't do that in our land. It's against the law. It's against the state law or the local law. So what will happen to the investments? So that will result to financial losses. In order to guide against that, you need to make your findings before you commit your hard-earned financial resources into setting up the business. That's number two that I said. Number one, I said the company will need to confirm whether there is requisite technical know-how, in-house technical know-how, okay, or expertise to produce the component. Then number two, the company will need to confirm if they are permitted by law, okay, to produce the component. Then number three, the company will also need to consider, you need to take into consideration the need to protect the degree of secrecy or proprietary information underlying the products. Because like I mentioned earlier, every product is unique. That degree of secrecy that underline the products must be protected. Must be protected. Not only that, if the company decides to produce the components internally, the company will also, another factor the company should consider is to confirm or to ascertain if sufficient storage space or facility are available. If you want to produce, you will need the space, you need the storage space. So if you don't have adequate storage space, that may prevent the company from producing sufficient a number or quantity of that particular component. So these are some of the factors we need to consider internally if the company decides to produce the component. What if the company, what are the factors you need to consider if the company wants to outsource it? Okay. One other factor is that the company will need to find out, or you need to ascertain if there is a reliable supply. Do we have a reliable supplier? Okay. Do we have a reliable supplier who can deliver according to a specification? Okay. So the company will need to provide answer to the question that do we have a reliable supplier who can deliver according to specification? When you talk about specification, however you want your product to look like, can the company say, for example, you have a product that look like this. You have a product that look like this, okay? Don't mind my drawing, just an example, okay? Say you have a product that look like this. This is specification. Therefore, you need to confirm or you need to ascertain if we have a reliable supplier who can deliver according to specification, the way you want it. Do you have a supplier that can deliver the way you want it? That's our specification. So that's another factor you need to consider if you are contracting it to an outside supplier. Then two, you also need to consider if the reliable supplier can satisfy our existing capacity level. If you say you want 100,000 kilograms of that raw material or components, the supplier must be able to deliver, must be able to satisfy the existing capacity level. Not that when you say you need 10,000 kilograms, the supplier will now say, okay, we are bringing 6,000 now. The balance of 4,000, we'll bring it tomorrow. That tomorrow may not come, maybe until one week later, and that may disrupt our production process. And as a result, it may even result to loss of contribution to the organization. So the company must ensure that the reliable supplier can satisfy the existing capacity level. Whatever quantity that you want, you can get it anytime, any day. So that's another factor you need to consider if the company wants to contract it to an outside supplier. Not only that, you also need to consider if the reliable supplier can offer a long-term arrangement. It's not just a one-off thing, because you want to continue patronize this, the supplier, the supplier on a consistent basis, on a going concern basis. Therefore, does the supplier has the capacity to deliver, okay, to deliver or to offer a long-term arrangement? All of this you need to take into consideration. Another factor is if the company has been producing that component in the past, then you now want to contract to an outside supplier, then you must ascertain that the supplier can maintain they can maintain better quality control of the product, okay? Better quality control of the, can maintain the quality of the product, because customer has already tasted the company's product. They know how it is in the market. Now, if you now decide to contract to an outside supplier, so what the supplier will produce should not be materially different from what customer are already used to. Because once there's a change in taste and preference, then that may result to loss of revenue for the company. So these are the factors you need to take into consideration in relation to make or buy decision. So let me hear from you if you have any question before we move to calculation. Any questions so far? Yes, Kunle, talk to me.
Yes, sir. Would it matter if two companies and a decision has been reached to make one of their products, but then when we consider the second product, the supplier's quotation and the relevant cost are the same, would it matter based on qualitative factor to decide to make that product internally? Would it go as one of the factors, in addition to the ones you have mentioned, the fact that the goods are complementary?
If the goods are complementary, what you are saying is that you have to, because I didn't get your introduction part of the question, your line was breaking then. So
okay.
If you talk, yeah, you want to
Can
take
I
it
come
again? Yes,
yes,
take
sir.
it again.
I'm saying, if, for example, if the company produces two products and the two products happens to be complementary,
Okay.
it had made a decision to make one of the products, but then when it considered the second product, the supplier quotation for the second product and the relevant cost are the same. Would the fact that both products are complementary come to play when making qualitative decision to make that product internally?
If supplier's quotation and relevant costs are the same, the company can decide, the company has a choice to either continue to make it or to just outsource it. So it will not really matter. Another factor the company will need to consider is that, okay, since they are the same, let us just contract with an outside supplier so that we can focus our attention on something more that are more critical to the company's success factor. So, yeah. Okay, Kunle?
Yes, sir. Thank you, sir.
You're welcome. So let's have illustration. Let's start with illustration number 2 first. Who will help us to read? Illustration 2.
Shango Tedo Nigeria Limited
Thank you, Tifa.
produces and sells to wholesalers a highly successful line of summer lotion and insect repellents has decided to diversify in order to stabilize sales throughout the year. A natural area for the company to consider is the production of lotions and creams to prevent dry and chapped skin. After considerable research, a product has been developed. However, because of the conservative nature of the company management, Shango Tedo management has decided to introduce only one of the new products for the coming season. If the product is a success, further expansion in future years will be initiated. The product selected, called Chap Off, is a lip balm that will be sold in a lipstick type tube. The product will be boxed. Because of the available capacity, no additional fixed charges will be incurred to produce the product. However, 100,000 naira fixed charges will be absorbed by the product to indicate fair share of the company's present fixed cost to the new product. Using the estimated sales and production of 100,000 boxes of chap-off as the expected volume, the accounting department has developed the following cost per box: direct material 3 naira, direct labor 2 naira, total overhead 1 naira 50 kobo. Shangotedo Nigeria Limited has approached a cosmetic manufacturer to discuss the possibility of purchasing the tubes for chap-off. The purchase price at the 24 empty tubes in a box from the cosmetics manufacturer is 90k. With this purchase proposal, it is predicted that direct labor and variable overhead cost would be reduced to 10% and direct material cost would be reduced to 20%. Required: 1. Should Shangotedo Nigeria Limited make or buy the tubes? Show calculation to support your answer. 2. What will be the maximum purchase price acceptable to Shangotedo Nigeria Limited for the tubes? Show calculations to support your answer with an appropriate explanation. 3. Instead of sale of 100,000 boxes, revised estimate shows sales volume is 125,000 boxes at any volume above 100,000 boxes. Additional equipment at an annual rental of 10,000 naira must be acquired. Under these circumstances, should Shangotedo Nigeria Limited make or buy the tubes? Show calculations to support the answer. 4. The company has the option of making and buying at the same time. What would be your answer to requirement 3? If this alternative were considered, show calculation to your answer.
Thank you very much, Tife. Yes.
You're welcome, sir.
That is the question. That is the question. The examiner is asking you, requirement number 1. Should Shangotedo Nigeria Limited make or buy the tube? Show calculation to support your answer. So this is make or buy decision. So in that case, what am I supposed to do? I will go into the question, identify supplier's quotation, then I will compare with relevant cost of making the tube. Okay, whether it will result in a saving or deficit to the to Shangotedo Nigeria Limited. So let me stop sharing this and move to the working note quickly. Okay, illustration number 2. Is it number 2? No, so number 1. Simply put, make or buy. Okay, so illustration, solution to illustration 2. Shangotedo Nigeria Limited. Number A, requirements. Examiner is asking you to advise whether Shangotedo Nigeria Limited should make or buy the tubes. So we need to compare supplier's quotation. In this case, since we have a format already, so savings, you want to determine savings or deficits from making the tube. Okay, savings or deficit from making the tube. Okay. So all we need to do is to compare supplier's quotation versus relevant cost of making. I would then, now, you have 2 options to present your savings or deficits. You have 2 options. You can either use par value for your calculations, or you use absolute number for your calculation. If I want to do absolute number, I will go to the question and identify supplier's quotation. According to the question, you are told that the purchase price, immediately after the table, you are told that the purchase price of the 24 empty tubes in a box from the cosmetic manufacturer is 90 kobo. So supplier's quotation is 90 kobo per box. So if that is the case, if I want to use absolute number, I will just multiply 90 kobo by 100,000 boxes. That will give me 90,000 naira. But if I want to use per value, I will just use only 0.9. That is 90 kobo. And that's what I'm going to use because it will be faster. So I will then come here. I will say suppliers quotation. Number A, 90 kobo, 0.90. You close. Then I will compare this with relevant costs of making the tube in the box. Okay. I will go back to the question. Am I given direct material? Yes. The direct material given in this question is 3 naira per box. Remember, the supplier's quotation is 90 kobo. Even direct material of 3 naira is more than the supplier's quotation. But examiner has already told you in the last paragraph, before the requirement, examiner has told you that with this purchase proposal, what is the purchase proposal? 90 kobo. It is predicted that direct labor and variable overhead costs will be reduced to 10% and direct material costs will be reduced to 20%. So direct material will be reduced to 20%. Therefore, I would then say direct material. Direct material is 20% of 3 naira. Sorry, not 30. So which is 0.60. Direct labor. Examiner has told us that direct labor will be reduced to 10%. Therefore, 10%, according to the question, direct labor is 2 naira. So that will give us 0.2, that is 20 kobo. Then go back to the question. We have total overhead. Pay attention here. Total overhead of 1 naira 50 kobo. Remember my explanation when we had operating statements. I mentioned to you that, in fact, I said the same thing when we had relevant costing. I said to you that overheads are divided into two. We have variable overhead, that's also fixed overhead, and that only the variable overhead is relevant. The fixed overhead is not relevant. So in this question, the examiner has given you total overhead of 1 naira 50 kobo. If there is no additional information in the question, the total overhead of 1 naira 50 kobo is irrelevant, you ignore it. However, you go into the question, go and identify if there's any way you can calculate your total variable overhead. As you can see from this question, we don't have any information that relates to variable overhead, but we have information on fixed overhead. How do I mean? When you go to the third paragraph of the question, examiner has told you that because of the available capacity, no additional fixed charges will be incurred to produce the product. However, 100,000 naira fixed charges will be absorbed by the product to indicate fair share of the company's present fixed cost to the new product, using the estimated sales and production of 100,000 boxes of chop-off as the expected volume. Okay, so there's a fixed cost of 100,000 naira at the activity level of 100,000 boxes. So in this case, my fixed overhead will then be 100,000 naira divided by 100,000 boxes, which is 1 naira. So if my fixed overhead is 1 naira, my total overhead is 1 naira 50 kobo. Therefore, variable overhead will be 1 naira 50 kobo minus 1 naira, which is 50 kobo. So this is what we are going to do. So I will then go and do my working for that. Second table, third, let's see if this one can be sufficient. So working for this. Working number 1, we want to determine variable overhead. Variable overhead. So like I said, variable overhead is equal to total overhead. Let me use, okay. Is equal to total overhead minus fixed overhead. Therefore, variable overhead will then be equal to total of 1 naira 50 kobo minus fixed overhead. How much is fixed overhead? Examiner has told us that there is a fixed charges of 100,000 naira at the activity level of 100,000 boxes. So this will give us the fixed overhead of 1 naira. Therefore, the variable overhead will then be equal to 50 kobo, 0.50. That's the variable overhead. Now that we have the variable overhead, I can then proceed to adjust for that, because examiner has told us that the variable overhead will be reduced to 10%. So I will then say variable overhead working number 1 equal to 10% of 50 kobo, which is 5 kobo, 0.05. Okay. So what else? What other costs do we have in the? I think that's all. That's all the costs. So in that case, I need to sum up. Here will be 80 kobo, 85 kobo. So that's the total variable. That's total relevant cost per the box. Here is B, total relevant cost per the tube. Okay, so our savings will then be equal to the difference between the two, which is 0.05. 0.05, that is A minus B. This is B. This is A. C equal to A minus B. All right then. So examiner is asking you to advise. You have to advise whether the company should make or buy the tube. Since supplier's quotation is greater than the total relevant cost of making the tube, then the company should make. So I would then say decision. Decision. Make. Okay. Next. Number 2. What will be the maximum purchase price acceptable to Shangoto Edo Nigeria Limited for the tube? Show calculation to support your answer with an appropriate explanation. Okay. So what will be the maximum purchase price acceptable to the company? Something that costs you 85 kobo to produce. Can you pay more than that? No, you can't pay more than 85 kobo. Therefore, I would then say, let me go to the next one. Number B, number 2, the maximum purchase price acceptable to Shongutedu, Nigeria Limited is 85 kobo per tube. Representing, let me write that, the total relevant cost per tube, total relevant cost per tube. Okay, as shown in the calculation below. As shown in the calculation below. So all what you have done before, you already have the number, but what you have done before, just repeat it. So I'll just say maximum price. Direct material. Direct material is 3 naira. We are told to reduce to 20%. 0.60. Direct labor of 2 naira. We reduce to 10%. 20 kobo. Then variable overhead of 5 kobo reduced to 10%, which is 5 kobo. Variable overhead of 50 kobo reduced to 10%, which is 5 kobo. Add it up, that's 85 kobo. So that's the maximum price. So that's what the examiner is asking you in the second requirement. Next item, number 3. You're now told that instead of sale of 100,000 boxes, revised estimate shows sales volume of 125,000 boxes. At any volume above 100,000 boxes, additional equipment at an annual rental of 10,000 naira must be acquired. Under these circumstances, should Shongotedo Nigeria Limited make or buy the tube? Show calculation to support your answer. Remember, in all our calculations so far, the activity level is based on 100,000 boxes. Examiner is now telling you that instead of that 100,000 boxes, revised estimate shows 125,000 boxes. And at any point above 100,000 boxes, the company will incur equipment rental of 10,000 naira. So as a result, should the company make or buy the tube? So in this case, what are we supposed to do? Without wasting time, I'll just say number 3, saving or deficits from making 125,000 boxes. Now, ordinarily, I would have done the same thing as I have done previously by making my numbers to be par value. I can make my number to be par value. But in this question, in this requirement number 3, examiner has told you that there's an equipment rental of 10,000 naira. Therefore, we can make our numbers to be absolute number. If not, if I don't want to make it absolute number, I can also divide 10,000 naira, I will divide by 125,000 boxes. Well, I'm still going to get the same thing. I will still get the same thing. So, without wasting more time, I will then come here. Supplier's quotation. For 125,000 boxes, supplier's quotation is 90 kobo. So what do you have? What's 0.9 of 125,000 boxes? What do you get?
112,500.
112,500 naira. So that represents the total supplier's cost. So I need to compare this with relevant cost of making the 125,000 boxes. So I have direct material to be 125,000 boxes multiplied by 0.60. What do you have there? Direct labor, 125,000.
75,000.
75,000. Thank you. Then direct labor is 125,000 boxes multiplied by 20 kobo. What do you have there? We also have variable overhead.
25,000.
25,000. Thank you. We also have variable overhead. 125,000 boxes at 5 kobo. What do you have there?
6,250.
Thank you. We also have equipment rental of 10,000 naira. 6,250. Equipment rental, 10,000 naira. Because we are told that at any point above 100,000 boxes, the company will incur equipment rental of 10,000. So add up the relevant cost. Total relevant cost. What do you have there?
116,250.
116,250. This is B. This is A. So A is less than B. Therefore, the company should buy the entire 125,000 boxes. So decision. Examiner is asking you whether they should make or buy the tube. So the company should buy. Shangotedo, Nigeria Limited should buy. Let me write it. Should buy the tube. Since it is cheaper. Finally, number 4. You are now told that the company has the option of making and buying at the same time. What will be your answer to requirement number 3? If this alternative were considered, show calculation for your answer. Okay, the company has the option of making and buying at the same time. No space again, so let me go after the working. Number 4. So the company has the option of making and buying at the same time. In this situation, what are we supposed to do? Let me throw it open. We are told that considering requirement number 3, the company has the option of making and buying at the same time. What are we supposed to do? Kunle, you want to try?
Yes, sir.
So talk to us.
So okay, it's my own opinion. I feel that since it is cheaper to make once production level is within 100,000 units, and then when we are considering the other aspect of producing 125 units, it is cheaper to buy. So I would advise that probably, and they have also given us an option that we can both make and buy. So I would ordinarily advise that we make 100,000 since it's cheaper to make it, and then the remaining 25,000 on it we can um, I mean contract it to outside supplier. We can then compare the cost to the cost of buying the entire 125 units. Whichever one is cheaper, I think go for it.
All right. Thank you, Kunle. I think you're on point. That's what we need to do. That's what we need to do. So in this case, we have three options in front of us. Option number one is for the company to make the entire 125,000 boxes at 116,250, because examiner is referring to requirement number 3. Then the second option is for the company to buy entirely the 125,000 boxes at 112 naira, 112,500 naira. Then option 3, the company can, since it is cheaper to make 100,000 boxes at 85 kobo relative to supplier's quotation of 90 kobo, then the company should make 100,000 boxes. Then the balance of 25,000 should be bought from outside supplier. So let's see how that will work out. So I would then say option 1. Option 1, buy 125,000 boxes at what price? At 112,500. Option 2, make 125,000 boxes. Okay, make 125,000 boxes at 116,250. Then option 3, the company can make 100,000 boxes at 85 kobo. That will give us 85,000 naira. Then the balance of 25,000 boxes can be bought at 90 kobo supplier's quotation. What do you have there? 25,000 multiplied by 0.9, 22,500. When you add up, that will be 107,500. So option to make and buy. Make and buy. So our advice is that the company should make 100,000 boxes at 85,000 naira and buy 25,000 boxes at 22,500 naira. So that's that. That's the end of the question. That's the end of the question. Let me know if you have any question for me. Some of you have disappeared. Tom Grace, you want to talk to me?
Yes, sir. Sorry to take you back. Please, can you just briefly go through the solution 3 again?
Solution 3, this one.
Yes, sir. I was lost at a point. Can you just briefly go through it again?
Yes, examiner is asking you that they want to produce. Let me go back to the question. Requirement number 3, you are told that instead of sale of 100,000 boxes, revised estimate shows sales volume of 125,000 boxes, and that at any volume above 100,000 boxes, additional equipment at an annual rental of 10,000 naira must be acquired. Under these circumstances, should the company make or buy the tube? Show calculation to support your answer. So like I said previously, all what we have calculated from number 1 to 2 requirements, they are based on 100,000 boxes. So examiner is now telling you that revised estimate has shown that they want to produce 125,000 boxes, and that at any point above 100,000 boxes, an equipment rental of 10,000 naira must be acquired. So if that is the case, should the company make or buy the tube? So what you are supposed to do in this case is that you pick the supplier's quotation of 90 kobo, you multiply with 125,000 boxes. So that will give us 112,500. You proceed to calculate your relevant cost. Everything must be based on 125,000 boxes. That's the activity level. And you know that your direct material cost per unit or per box is 60 kobo. So 60 kobo of 125,000 activity level will give us 75,000. Again, direct labor is 20 kobo. 20 kobo multiplied by 125 will give us 25,000. Variable overhead, the same thing, 5 kobo multiplied by 125 will give you 6,250. There's an equipment rental given in the question, which is 10,000 naira. When you add up everything, you will notice that the total relevant cost is 116,250, which is higher than the supplier's quotation of 112,500. Therefore, our advice is that the company should buy the tube because it is cheaper to do so. That's that. Okay?
Thank you, sir. Thank you.
You're welcome.
Hello, sir.
Yes, talk to me.
In the format you gave us earlier,
Yes.
there's opportunity cost there. Please, what do they mean by opportunity costs?
Opportunity cost is the benefit forgone as a result of taking a particular course of action. So once you have, say for example now, let me just explain opportunity cost to you. Say I'm a lecturer and then I have a car, for example. That my car, I can use it for Uber service to generate revenue. So if I decide to drive my car to the center for the purpose of undertaking a lecture, I will not be able to earn the revenue that would have accrued to me through the Uber service. Therefore, if I want to determine my cost of lecturing, the benefits I've lost because of the lecture, I lost the benefits of revenue that would have accrued to me through Uber service. So that benefit should be part of my cost of taking the class, of taking the lecture. That is what is called opportunity cost. The benefit forgone as a result of taking a particular course of action. Okay, is it clear now?
Yes, sir. Thank you, sir.
You're welcome. Okay, so let's have another illustration. Let me stop sharing this and move to the next one. Okay. Hopefully the remaining minutes that we have will be sufficient to undertake this. So let's solve this illustration number 3. Illustration number 3. Who will help us? Tife has been the one reading since, so.
Okay, let me go, sir.
Okay, go ahead. Thank you.
Illustration 3. November 2021, question 2. Divine grace DG Limited currently makes as many units of Part 2011 as it makes. The company has recently received a bid from another company, KKPLC, for making Part 2011. The company will supply 1,000 units of Part 2011 per year at 100 naira a unit. The company can begin the supply and continue for 5 years, after which time DG Limited will not need the parts. KKPLC can accommodate any change in DG Limited's demand for the parts and will supply it for 100 naira regardless of quantity. Ayo Ayuba, the cost accountant, reports the following cost for manufacturing 1,000 units of Part 2011. All figures are assumed to be correct. The following additional information is available. 1. Part 2011 is made on a machine used exclusively for the production of Part 2011. The machine was acquired on January 1 last year at a cost of 120,000. The machine has a useful life of 6 years and zero terminal disposal price. Depreciation is calculated on the straight line method. 2. The machine could be sold today for 30,000 naira. 3. Product and process engineering costs are incurred to ensure that the production process for Part 2011 works smoothly. Although these costs are fixed in the short run, with respect to units of Part 2011 produced, they can be saved in the long run if Part 2011 is no longer produced. If Part 2011 is outsourced, product and process engineering cost of 8,000 will be incurred for next year only. Rent costs of 8,000 are apportioned to products on the basis of the floor space used for manufacturing the product. If Part 2011 is discontinued, the space currently used to manufacture it will become available. The company could then use the space for storage purpose and save 2,000 currently paid for outside storage. Number 5, general overhead are apportioned to each department on the basis of direct production labor cost. These costs will not change in total, but no general overhead will be apportioned to Part 2011 if the part is outsourced. Assume the required rate of return is 12%. Required. A. Should DG Limited outsource Part 2011? B. What maximum price should KK Limited quote on the 1,000 units to make divine grace indifferent between outsourcing and internal production? And C. What non-financial factor would favor internal production rather than outsourcing?
Yes, thank you very much, Kunle. That's the question. That is the question. You can see in our previous calculation under make or buy, we did not have anything that has to do with cost of capital, that is the required rate of return. This is surprise. When this question was tested, most students did not get it right. Most students did not get it right because they did not understand why they have to use the cost of capital of 20%, because the deviation from the normal things that they know. However, because of the fact that you have been given a cost of capital of 12%, it means that you are supposed to discount the future expected cash flows arising from this part 2011. So you are supposed to discount it to its present value equivalent. So whenever you are given a cost of capital or discount rate in a question, it means that you must discount it. You want to calculate present value. So to solve this question, what are you supposed to do? Very simple. There are two options available. One is to make part 2011. One is for DG to make part 2011 internally. So the second option is for DG to outsource part 2011 to another company. Remember what I told you. when we started, the primary purpose of make or buy is to achieve saving and to also ensure that a reliable supplier is available to satisfy the existing capacity level. So in this case, what you are supposed to do first is to accumulate all the costs that will be incurred by the company internally. If the company wants to make per 2011, what are the relevant costs that you are going to incur? So you are going to accumulate all those costs. Then after you have accumulated them one by one, okay, from the in this case, for internal production, you are going to need direct material cost. You will need direct labor cost. You are going to need variable production overhead. Remember, depreciation is a non-cash item. When you see depreciation, you ignore, it's a non-cash item. So product and process engineering. Examiner has told you that process and engineering costs are incurred to ensure that the production process for part 2011 works smoothly. Although these costs are fixed in the short run with respect to the unit of part 2011 produced, they can be saved in the long run if part 2011 is no longer produced. So if part 2011 is absorbed, product and engineering costs of 8,000 will be incurred. So the bottom line is that this company, DG, if DG decide to produce part 2011, they are going to incur product and process engineering, because according to them, according to the question, we are told that product and process engineering costs are incurred to ensure that the production process for part 2011 works smoothly. So that means if they don't incur product and process engineering, there will be each in the production run. At least production run will not go smoothly. Then rent is not relevant, okay? Because examiner has told you that the rental costs of 8,000 are apportioned to products on the basis of the floor space. Anything apportionment is irrelevant. So you ignore the 4,000. General overhead is irrelevant. You ignore it. So what that means is that the 4 line item, they had the relevant costs that the company will incur if the company decide to produce part 2011 internally. So now that I know the cost, all I need to do is to now use the 12% discount rate to calculate the present value. So I would then say, if I like, I can add up 44 plus 22, that's 66. 66 plus 14, that's 80. Then 80 plus 8, that's 88. If I like, I can discount 88,000 naira. Okay, the total relevant cost is 88,000 naira. What is for how many years? Okay, for how many years? We are told for 5 years. I saw that information somewhere the other time. Why did they mention 5 years?
6
First
years.
paragraph.
Pardon?
First paragraph, the first introduction.
Yes, I've seen it. The company can begin to supply and continue for 5 years. So that's that. So what this simply means is that this 88,000 that I have here, I need to calculate annuity factor of year 1 to 5, because the 88,000 is constant. Year 1, year 2, year 3, up to year 5 is the same 88,000, because that cash flow is constant. So I need to calculate annuity factor. Once I have my annuity factor, I will multiply with 88,000. That will give me the total present value. Okay, total present value for internal production. Okay, then I will now do the same thing for outsourcing. If the company decide to outsource the part 2011, we are told in the question that the company will supply KKPSC. Okay, let me read it. The company has recently received a bid from another company, KKPSC. So this KKPSC is the supplier, is an outside supplier for making the part 2011. So the company will supply 1,000 units of part 2011 per year at 100 naira. So 100,000 units multiplied by 100 naira will give us 100,000 naira. So we keep it on one side, which is cost of supply or supplying cost. Supplying cost equal 1,000 units multiplied by 100 naira. That is 100,000. That you are told that per year. So since this project is for 5 years, so I'm going to calculate annuity factor of year 1 to 5. Okay, annuity factor of year 1 to 5. I'll keep it on one side. Then examiner is now telling you in the additional information that, okay, because of time, it's already 12:50. Let me do it this way. Let me see if I have this document open, so that we just use the prepared solution to explain that without extending the normal lecture hour. Let me stop sharing this, please, so that in our next class, we just go straight to acceptance or rejection of a special order. Let me see. Let me quickly open it. Okay. Open. Good. Let me share my screen with you. Let me know if you can see my screen.
Yes, sir.
Okay.
Yes, sir.
Thank you. Okay then. Short-term decision. Make or buy. Make or buy. Okay. Yes. No, not this one. Yes, this is it. Okay. So let's use this prepared solution here to explain it. Of course, I've changed the name from DG to Skeletal Limited, so it's still the same thing. Now, yes, without wasting more time, because we have about 7 minutes more. So when you look at my explanation here from the introduction, what's wrong with you? From the introduction, I've already explained that, so I don't need to go back to it again. So you do use of a cost of capital of 12%. Okay, so I've already explained that. So to solve the question, let us bring out the variable need. I've already also explained this, but for the part of the outsourcing, you want to outsource the part 2011 to KK Limited. Therefore, you are going to pick. We are told that the company wants to supply 1,000 units at 100 naira for the next 5 years per year. So which means for the next 5 years. So when you multiply 1,000 units by 100 naira, that will give you 100,000 naira. You keep it on one side. And this 100,000 naira is meant for year 1 to year 5, because we are told it's per year. Then I need to go back to the question. I need to go back to the question. In the additional information about 1, examiner has told you that part 2011 is made on a machine used exclusively for the production of part 2011. The machine was acquired on 1st January last year at a cost of 120,000 naira. The machine has a useful life of 6 years and 0 terminal disposal price. Depreciation is calculated on a straight line basis. So if that is the case, if the cost of the machine is 120,000 naira, and you are given the depreciation and the useful life of 6 years, therefore 120,000 divided by 6, that will give you 20,000 naira. So examiner is only explaining to you how they arrive at the depreciation of 20,000. All right, so that information is irrelevant. So the depreciation of 120,000 is irrelevant because when you are stating your assumption, you are supposed to talk about that. Then additional information number 2, we are told that the machine could be sold today for 30,000 naira. When you get to professional level, you are going to do strategic financial management. So in that, when you get there, you are going to learn about capital budgeting, and at the same time, you learn about capital budgeting decision. You're also going to learn about cost of capital. However, when you are told that a cash flow that occurred today means immediately. Today is year 0. Okay, we are told that the machine could be sold today for 30,000 naira. So this today simply means year 0. So when I want to calculate savings from the machine disposal, it will be only for year 0. And discount factor at year 0 is equal to 1. So let's go back to my notes, how I was able to adjust for that. Look at machine disposal. It's a saving because we are disposing it. Today means year 0. So when I want to calculate my NPV, so this 30,000 will be only for year 0 because examiner has said today. Examiner can say today or immediately. Whether it is today or immediately, it means year 0. So when I want to discount this 30,000, discount factor at year 0 is equal to 1. So that means the 30,000 will not change. However, this 30,000 is a saving. Therefore, it has to be in brackets. Remember, you are calculating cost. You are calculating cost. Therefore, since the machine disposal is a saving, it's a cash inflow. So you put it in bracket in order to reduce your total cost. Then the next item is process and product and process engineering. Let's go back to the information on process and then additional information number 3. Product and process engineering costs are incurred to ensure that the production process for Part 2011 works smoothly. Although these costs are fixed in the short run, with respect to the unit of Part 2011 produced, they can be saved in the long run if Part 2011 is no longer produced. If Part 2011 is outsourced, product and process engineering cost of 8,000 naira will be incurred for the next year only. Next year only means year 1. Before you can count 1 year, you have to, for you to be able to account for 1 year, you have to count for 12 months. So when you say in the next year only, meaning that only year 1, okay, for year 1 only. So meaning that this product and process engineering cost of 8,000 will be incurred in year 1. And that's why you are seeing in my analysis here, product and process engineering year 1 only. Okay, year 1 only, which is 8,000 naira. So because when I'm discounting or when I'm calculating my present value, it is important you have to know, because there are 3 attributes of NPV, or there are 3 criteria of NPV. 1 is relevant cash flow, then 2, appropriate cost of capital, then 3 is the useful life. If any of the 3 is missing, there is no way you can compute for NPV. The 3 of them must be present. So in this case, what we are trying to do in this analysis is for us to be able to identify relevant cash flows. Then the appropriate cost of capital that have been given to you in this question is the 12% cost of capital discount rate. Then the third one, which is the useful life. The useful life, the essence of the useful life for us to be able to determine this one is for 5 years, this one is for year 0, this one is for year 1. Then the last one, which is storage space. Let's go back to the question, storage space. In additional information number 4, you are told that rent cost of 8,000 naira are apportioned to products on the basis of the floor space used for manufacturing the product. I've told you anything apportionment is irrelevant. Therefore, this 8,000 is a no-go area, so you ignore it. If Part 2011 is discontinued, the space currently used to manufacture it will become available. The company could then use the space for storage purposes and save 2,000 naira currently paid. So 2,000 naira is a saving for the storage space. So there is a saving of 2,000 naira currently paid. Currently means per year, okay? Because you are told that, look at what examiner is telling you there. The company could then use the space for purposes and save 2,000 naira currently paid for outside storage. So you are saving it. So that means year one, 2,000, year two, 2,000, year three, up to year five. So the company will save the 2,000 naira. So again, you put this one in bracket because it's a saving. What you are doing is cost. So when you have a saving, you have to put it in bracket. So again, this one will be for year 1 to 5. That saving is for year 1 to 5. Now that I've done for outsourcing, I've already told you already what we are going to do under the internal production. Because if I'm doing it, if I like, I can do it one by one because those are relevant cash flow that I need. If I like, I can add up everything that make us 88, that make up 88,000. So instead of me to be doing it one by one, I'll just use 88,000. Since 44, 22, 14, and 8,000, they will be affected with the same discount factor. So I can decide to add everything together and multiply with the annuity factor. I'll be good to go. So these are the relevant cash flows that we have identified from the question. The next thing I need to do now is to calculate the present value for each option. Option 1 is for outsourcing. Option 2 is for internal production. So when I want to calculate my NPV, so all those items that I've accounted for here, all these items that I've accounted for here, so I need to go and calculate NPV for them. So supplying cost or cost of supplying 1,000 units, which is 100,000 naira. This is the 100,000 naira you have here. The machine disposal, I will go back to where I've analyzed it. Machine disposal is for year 0, 30,000 naira. It's a cash inflow. That's why we are seeing it in brackets. Okay. Then the next one, product and process engineering, which is 8,000 naira. So we also have it there for year 1 only. That's the 8,000 you are seeing here. Then storage space is also a saving. Storage space is a saving of 2,000 naira for the next 5 years. So that's what you have here. So the next thing I need to do now, for me to get my present value, okay, for me to get my present value, I need to multiply, okay, I need to multiply the discount factor or the annuity factor with the cash flows. The first cash flow, cost of supplying 100,000 naira. This 100,000 naira is meant for 5 years, from year 1 to year 5. Therefore, I need to go and calculate annuity factor. How do you calculate annuity factor? Annuity factor, denoted as AF, is calculated as 1 minus, open a bracket, 1 plus R raised to power minus N, all of this divided by R. So in this case, I would then say annuity factor equal to 1 minus, my cost of capital is 12%. So 12% plus 1 will give me 1.12. Then raised to power, N is the useful life. N is the useful life of part 2011. We are told that the useful life is 5 years. So N minus 5. So all of this divided by the cost of capital of 12%. So, and that is what produced my AF is equal to 3.605 when you use your calculator. So that is how we got this 3.605. When you multiply 3.605 with 100,000, it will give you 360,500. Okay. The next item from my analysis above, which is a machine disposal of 30,000 naira. So machine disposal of 30,000, because that machine disposal, we are told today means year 0. So that's why you have seen 0 here. So discount factor at year 0 is equal to 1. 1 multiplied by 30 will give us 30,000. So that's how we got that number. Then process and product and process engineering is for 8,000 naira for year 1 only. Okay, for year 1 only. So I need to calculate discount factor for year 1. So how do you calculate discount factor? So discount factor is calculated as 1 plus R raised to power minus N. Therefore, discount factor for year 1 will then be, my cost of capital is 12%. That's 1.12 raised to power minus 1. So that's what gave us the number you have there, which is 0.893. That is what gave us 0.893. So when you use your own calculator to confirm the numbers. So that's how we got this number. Then you multiply 0.893 with 8,000. That's how we got 7,144. Then for the storage space, again, 2,000 is a saving for year 1 to 5. Discount factor multiplied. So at the end of the day, the total net present value for outsourcing is 330,434 naira. Then the second option, is internal production. I want to determine present value of making per 2011 for internal production. You want to produce per 2011. Again, like I said, we have already identified all these numbers. All I need to do now, each of them is for year 1 to 5. So, and the annuity factor of year 1 to 5 at 12% is 3.605. So, the total present value is 317,240. If I don't want to follow this route, like I mentioned the other time, you just do 88,000. Add up all this number together. That's 88,000. Okay. So instead of me to be doing it one by one, I can just add up all of the numbers because they are affected with the same annuity factor of 3.605. You can see all of them, they are 3.605. So instead of me to be doing it one by one, I'll just add all the cash flows together since they are affected with the same annuity factor. So that's how we got 317 at 240. So examiner is now asking you whether the company should, let me go back to the requirements. So you should DG Limited outsource past 2011, 10 marks. 10 marks is what you want to earn. Therefore, all you need to do is to compare the supplier's quotation versus relevant cost of making. In this case, my relevant costs have already discounted to the present value equivalent. Again, the cost of outsourcing, the supplier's quotation, have also discounted it to the present value equivalent. At the end of the day, we notice that the supplier's quotation of 330, 434 naira is higher than the relevant cost of making per 2011. So there's a saving. There's a saving of 13,194. Therefore, our advice is that DG Limited should produce or should make per 2011 internally in order to save 13,194 naira. So that is what we did there. And then again, because this question involves some assumptions, we have made some assumptions by saying that, okay, we are given machine. Why did you ignore the cost of the machine of 120? We said that it is assumed that the machine is owned by Podolsky, in this case, it's KK Limited. However, the original cost of the machine of 120,000 is a sunk cost and therefore ignored. Depreciation. This is a non-cash item and therefore not relevant to the calculation. We are explaining to the examiner how you got your number and why did you ignore some numbers, which is the key thing that I told you when we had a relevant costing. Then for the rent, the cost of rent of 8,000 is an apportionment and not relevant, therefore ignore in this calculation. General overhead, the general fixed overhead is an apportionment and will be incurred irrespective of whether part 2011 is produced or not. Okay, therefore the general fixed overhead is irrelevant. That's all. You earn your 10 marks. Then the number B part of the question, quickly within the next 2 minutes, the number B part of the question, examiner is asking you, what maximum price should DG Limited quote on the, should KK Limited quote on the 1,000 unit to make DG Limited indifferent between outsourcing and internal production? What the examiner is simply asking you is for you to calculate sensitivity margin of supplying cost. You know, supplying cost, the total supplying cost is 100,000 naira. We want to supply 1,000 units at 100 naira. So examiner is now asking you what should be the price at which KK Limited should quote in order to make the company indifferent, in order to make DG indifferent. When you are indifferent, that means you want to break even. You are neither here nor there. Okay, you want to break even. So if that is the case, what you are supposed to do here is for you to calculate sensitivity margin of the supplying cost. Okay, calculate sensitivity margin of the supplying cost. So for you to get your sensitivity margin, so it's simply, of course, it is expected that, this question is a past question. It is expected that you would have covered the syllabus. Ordinarily, I'm not supposed to solve this question because it involves sensitivity margin. I'll just wait till we do risk and uncertainty, because it is when we get to risk and uncertainty, we are going to learn about sensitivity margin in details. But however, this is a past question that we have to treat. So when you want to calculate sensitivity margin, it is simply the ratio of NPV to present value of the variable. In this case, the variable is the supplying cost. So NPV is 13,194. The PV of supplying cost is a 360, whatever. How much did you get the other time? Yes, 360,500 naira is the PV of supplying cost. So without wasting time, this is it here. So that's it. That's what, so the sensitivity margin is 3.66%. What this simply means is that the 100 naira per 1,000 units of the per 20 level can fall by 3.66%. Anything below this, anything below this, when we make the project, I mean, to become our NPV that is 13,194 will become zero, or will become less than zero. So that's the implication. So let me just, of course, let me just read through. To determine maximum price, KK Limited should quote on 1,000 Limited to make DG Limited indifferent between outsourcing and internal production. We need to calculate sensitivity margin of cost of supplying per 20 level. This is calculated as follows. So we got 3.66%. The supplier's quotation of 100 naira per unit can fall by 3.66 in order to break even. That is to be indifferent. Therefore, the maximum price KK should quote to break even is 96 naira 34 kobo, as shown below. So I will then pick the supplier's quotation of 100 naira. 3.66% of 100 naira will give me 3 naira 66 kobo. Therefore, for the company to be able to be indifferent, the company should charge 96 naira 34 kobo. When if the company charges 96 naira 34 kobo, there will be no NPV. The NPV will be equal to zero. The NPV of 13,194 naira will then be equal to zero, because this is the sensitivity, this is the maximum. This is the maximum level at which that the supplying cost can fall. Okay, the maximum level that the supplying cost can fall is 3.66%. So which simply means that the maximum price the company should quote is 96.34. In this case, this will make NPV to be equal to zero, which is break even. So that is for requirement number B. Then finally, requirement number C. In the requirement number C, examiner is asking you to state the non-financial factor that will favor internal production other than outsourcing. All you need to do, that's a bonus 5 marks. Bonus 5 marks. What you're supposed to do is to state your qualitative factors. If the company wants to produce internally, what are the qualitative factors the company should consider? So again, I've discussed some of this earlier today, but let me just, let's go through it together quickly. The following qualitative factor will need to be considered by the management of DG Limited before making the final decision. 1. Do we have the required manpower to manufacture per 2011 in addition to existing product? Remember, I told you, when you are stating your assumptions, when you are stating your qualitative factors, you need to link it with the question. Link it to the question. Don't make it too generic. If you memorize and you are just dropping it without linking it with the question, it will look as if everybody is doing the same thing. You have to make it unique. So each qualitative factor should be linked to the question under consideration. Don't make it generic. Then number 2, DG Limited, we need to ascertain if there is requisite in-house technical know-how or expertise to produce per 2011. Again, we have discussed this earlier today. Internal production may be favored over outsourcing to maintain better quality control to satisfy customer demand. Can you get that? So that's another one. Then number 4, do we have sufficient, the company will need to know, to ascertain whether there's sufficient in-house storage capacity that can accommodate per 2011. Okay. Then number 5, outsourcing per 2011 may result in labor disputes, which can impair the reputation of the company if not properly managed. Okay, if not properly managed. When you have sources, people that are already producing it before, they may become they may become troublesome, and then request that the company return to the status quo. Then number 6, the impact of outsourcing the per 2011 on workers' morale should be considered before this can be, because this can result in low productivity. Yes, so you need to consider the impact of outsourcing it, because the company is already producing per 20. If you decide to outsource it, it will lower morale. If morale is lower, then there will be low productivity. So these are the things that the company will need to consider as far as the qualitative factors are concerned. So that's end of the question. That's end of the question. Majority of you have disappeared. No worry, I understand. Okay, it's understandable. So that's end of the question. Let me hear from you if you have anything. Your line is breaking, Ahmad. I couldn't get that. Ahmad, take it again.
He was only trying to let you know that we are here.
Oh, okay. Yes, you disappeared before, you just reappeared again. Because I checked through, I couldn't find you. That's Abdul Latif. Yes.
Never.
Okay, no worries. Yes, Amon, you wanted to say something. Amon? Okay.
Yes. Actually, we are here.
Oh, okay. Thank you guys for holding on. Thank you for holding on. Yes. Any question for me so that we can just close the class for today? Sorry for taking extra minutes of your time. Yes. Any questions so far?
No, sir, I just want to play. This question, are you still going to take it again? Like, go through it again, or this is the end of it?
Go through what
Because
again? That's the end of the question now. What do you mean to go through again? Something I've already done.
you
And
actually
some
rushed.
you are doing what?
You were rushing. I said you were kind of rushing.
No, when you listen to the video, you get it now. Sure?
All right, sir.
Mm-hmm.
No problem.
Please
Yeah,
help us send these solutions out.
no worries.
Thank you, sir.
You're welcome. Okay, in the absence
Excuse
of
me, sir.
no, yes, Ruth, talk to me.
The last week lecture you took, you know the solution you did, you were reading it out, but you didn't send it to the group chat.
I think it's an okay. I will inform the admin in charge to share the video with you. Maybe you could not see it. I mean, thinking maybe it's one of the previous one, but again, we are going to share with you. One of you raised the issue earlier today. I think it was a shame. No worries, it will be shared. It
Okay,
will be
sir.
shared. Yeah.
Thank
Okay,
you.
guys. You're welcome. So thank you everyone for holding on. I really appreciate, and by the grace of God, we are going to meet next week, Monday. However, Mr. Shiwaju will take you on Wednesday. Good night, everyone.
Good night, sir. Thank you.
Good night. Congress.